Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you part two of the video the first video I did where I constructed a portfolio for someone who was retired, had $2 million to invest, and needed at least a 5% yield, generating about $100,000 a year in income. But even more importantly, we're endeavoring to construct a portfolio that would increase that income each year over time so that as a retiree, they would get a raise in pay every year, helping offset inflation and not have to sell assets or do anything. So let's go and take a quick glance at what that portfolio looked like. I'm going to do it through the window of the first video that I did in this series. So here you can see we've invested about 3/4 of the money. Remember, it's a $2 million portfolio that this hypothetical investor have. With these 15 stocks that we built, we have a 5.27% current yield. So we're a little over what the client needs. Now, this is the holdings and the weightings and what the portfolio looked like going forward. So let me move the video up a little bit, and maybe I need to move it back a little bit and show you a summary of what's been happening to the portfolio here after we initially built it. Here we go. All right, the portfolio, we invested $1.5 million. The total return was 1% at this time. This was like when the portfolio was 1 day old. This number doesn't really exist because it's an annualized rate of return, but on 1 day old, it doesn't really make any sense, and we're not showing any income earned at this point. But I do want to point out that we have these 15 stocks in here, and this is looking at the holdings period, holdings expression, but we only had 15 stocks. That's all that we care about for now. All right, so if we went to this portfolio, what I did was I needed to find 5 more stocks to add to this portfolio. Now, in addition to running the screens that I showed you in the first video, and I'll put a link to that video, you'll be able to look and be able to watch that video for those of you who missed it. What I did was I did some manipulating of screens. I went through some of the preset screens and some of the other screens, and I started looking for companies that didn't perfectly match what I needed in the portfolio, but pretty much did. So I created a view here to give you some insight. So the companies I came up with was CVS Health, Keurig Dr Pepper, JM Smucker, Constellation Brands, the alcohol producer, Target, Tyson Foods, the chicken people, and then Verizon Communications. Now, if you look at the dividend yield spreads I had here, I had the highest was 6.77%. Here's where I would use Verizon, and I'll explain that in a second, to give me a little higher yield because my goal is 5%. Okay, every other stock in this group of 7 that I originally came up with had yields of less than 5%. All right, so I had to use Verizon, was a no-brainer. I had to throw it in there so that I could make sure by adding these other 5 that I could still get my yield above 5%. And we'll look at that here in a moment. So these were my choices. They're all investment grade, BBB or better investment grade companies, with Target being an A-grade company. Again, I went through the dividend yields. All of them are trading at fair value, meaning that they have earnings yields above 6.5% to 7%. And that's critical as Mr. Valuation. I wanted companies that were attractively valued, and we'll look at that. Now, I added the free cash flow persistency score here. I wanted to see companies that generated good, consistent free cash flow. And then I also wanted to see free cash flow to equity growth. And these all had over above 50% free cash flow to equity growth. So what I did was then I picked 5 of these 7 to round out my portfolio from the 15 original that I had in the first view, where I built 3/4 of the portfolio. And now I've got the remaining portion of the stocks that I added to the portfolio, and I'll go through those with you. Okay, so now I've got $1,999,840.74 invested. Now the portfolio is a little over a week old now, with these 5 stocks only been added either yesterday or today, hypothetically and theoretically. The portfolio value has increased by $27,000, but again, guys, I don't care if it was up or down at this point. The portfolio is only a week old, and it really doesn't matter what it's doing. Now, from a technical point of view, the total return has been 1.51% over about a week's time frame, okay, for the majority of them anyway. Now, that would be an annualized rate of return of almost 67%, 66.59. That, again, is an irrelevant number on a portfolio that's so young. The inception date was November 18th for the majority of the stocks. And again, we added these 5 other names here. Okay, so now if I go to the holding section using the fast graph tool, I can see where my gains and losses are coming from. And I can look at it from a standpoint of whether I'm making money or losing money on these stocks. Now, I've got this in percentages. I'm sorry. Let me do it in terms of prices. All right, so if I got my gain and loss here column, I can see most of them have a gain, and about 5 or 6, 1, 2, 3, 4, 5 have losses. So that would mean 10 have gains. And I've got these 5 that have nothing because these are the new ones. Okay, so let's go ahead and go through those real quickly. Let's look at Keurig Dr Pepper. Now, this was an interesting company that came up because it's a company that has been historically a very fast grower. But one thing about fast graphs that I really want to emphasize, we are an analytical tool to think with, we call it. By instantly, you can just change time frames, you'll get different numbers. Now here we got a 21% growth rate, and we're using a PE ratio of 21, which is Peter Lynch's P equals growth rate formula that he made famous. But if I watch what happens when I drop this, you should never, if you are fast graph users, never use fast graphs without going through as many time frames. You can go through all of them, but like I like to do for expediency purposes, cut them down. I go from the max to the 15-year graph. Now the growth rate's only 11% a year. Okay, now that changes the value. We're actually drawing the orange line at a 15 PE, no longer drawing it at a 21 PE because we've had a reset of growth. And you see growth percentages at the bottom of the graph. Now I want you to notice the anomaly number here. Okay, it was a 500% growth rate. This is the year the company went public. So even if I drop that to 19 years, now I get about an 11% grower, which is probably more realistic than what the company actually did. All right. So now you can see that the price has tracked that, but then coming out of the recession of 08 and 09, that's what this gray shaded area is here. You can see it more clearly. It's 08 and 09. The company got undervalued, and we've had it tracked earnings perfectly for several years. Then we got overvalued. And look what happens when the stock gets overvalued. We have overvalued, and we essentially get a flat line of the stock price, about a 6% rate of return over that period of time. We get overvalued again here, and moving it to the current, we now all of a sudden only have a 1% rate of return on this stock for the last 5 years. But I want you to notice during this time frame, if I drop this to an 8-year graph, okay, that includes some forecasting data, I've only got 8% growth. Now I got a value at a 15 multiple. But again, my point being is that the stock has been a very poor performer price-wise, but the business has grown by over 8%. So if you could have bought this business when it was trading at a fair value, and you got to go all the way back to 2014 to find this trading at a fair value 15 PE ratio. Now, if you did that, even though it's undervalued today, over this time frame, which is a different time frame because you're averaging the different growth rates that you see at this bottom line here, you see a stock that's grown 11%, slightly undervalued. The annual rate of return has been just about approximately what the growth rate of the company's been. Plus the dividend gets you up to about a 13% rate of return. Now, there was a period of time, this is how valuation matters, and it matters a lot, where there was a period of time at this peak here where you were averaging over 22% a year, okay? But then you gave that back because the stock was overvalued. I want you to note here, because this is a very important lesson on valuation, when a stock gets overvalued, it doesn't mean that it can't continue to make you money even for years like we see here, but you're taking an extreme amount of risk and you're basically not participating in the growth of the company. Now, looking at this stock from a practical standpoint, the last thing you want to run is like the last 5 years of history, I like to run anyway, and then include the forecasting. Because here you're going to get what the more relevant growth has been recently. And this is a period of really poor performance again on the stock because the price was overvalued. I won't pick the top. And so the price has only averaged 0.14% a year, including dividends. It actually lost almost 12% of its value. An original $10,000 investment has shrunk to $8,800. but you got another $1,200 in dividends, so you eked out just a smidgen of a gain. But yet this is during a period of time when the business grew by 14%, 5%, 7%, and 6%. So I could tell you what that number actually is by using my scroll bar. But the growth rate over this period of time has been something like 7% a year. Okay, I didn't do that exactly right, but you get the point, I hope. Okay, now the forecasting graph, I want you to note, the historical 5-year growth has been about 7.5%. It's forecast by the analyst estimates, which again is iffy because analysts are forecasted at about 6.3% over the next 2.25 years. We're coming into December here. We only got 1 month left. So our forecasting gives you the current year you're in up to 2 years forward, sometimes 3, depending on the company and the time frame and what their fiscal years are. So the point is, you've got a rate of return here, potential of about 15% a year with a 3.27% dividend yield in a company that's historically raised their dividend year after year after year. So let's look at dividend growth, let's say, just over the last 15 years. The dividend has grown by a compound rate of 12%, an average rate of about 17%. But now that can be misleading because you also want to use this tool to think about it. It presents all this data. There's a periods of time where the dividend growth, by going back to my performance table I should have stayed on, the dividend growth rates have varied from high to low over different periods of time. But this is a good, solid company. We all know Dr. Pepper Keurig. It's a company that has decent growth potential. It has a moderate yield, and it fits very nicely with the portfolio. Because keep one thing in mind, if I go back to the summary page, I've maintained, now I've got the portfolio, for all intents and purposes, fully invested. Of the $2 million I originally had, not the $26,000, the $2 million, I've invested $1,996,000. So I've got a little money left over for whatever, and then I'll be getting dividends at a rate of about 5% a year. And I do expect those dividends to continue to grow in aggregate. So I will get my $100,000 a year in income off this portfolio, and hopefully it'll get $105,000 next year, $110,000. I'm just making those numbers up, but I'm going to get income growth every year thereafter because most of these companies have increased their dividend consistently, but at different rates. Okay, so now I've added the portfolio. The next stock that I added, if I go back to my holding page here and look at price and do my gains and losses, the next stock was J.M. Smucker. Okay, so J.M. Smucker, of course, we know is the jelly company. And looking at the summary, I'm going to go to the historical page because it's a little clearer. We've got a 4.5% grower, but it's very undervalued. The forecasting graph expects growth of about 5% a year, but because the stock is so undervalued, we have an opportunity to generate about a 24% rate of return. If it grows by 4.9%, if the dividend grows and increases as expected at the bottom here by approximately a 5% rate, and the PE ratio expands from the current PE of 11 to the fair value PE of 15, then we've got an opportunity here to earn, again, around 24% a year. So bottom line is that's another one that we added that we feel didn't make the first screen, but screened out very, very well for the second one. The next one is Constellation Brands, which of course is the largest liquor producer. They also own the Modelo beers, and those are very popular right now. But once again, we see a great lesson in valuation. This company's historical growth rate for the last 15 years has been 12%. If I go to max, it's been 10%. If I go to 10 years, it's been 4%. Okay, people get confused by this. I'm measuring different time frames and different growth rates, including some forecasting data, which you could always scroll the forecasting data out if you wanted to and see what the actual historical growth has been, about 3.5% to 4%. When I go to forecasting, they're expecting, again, a similar thing in terms of growth rates of about 4%, 3.8%. But because it's so undervalued, that still makes it worth 15 times earnings. I have a stock that could generate over a 20% rate of return over the next 2 years. Now, this has a February fiscal year, so you notice I've got essentially 10 quarters here before I calculate that number. Okay, that would be Constellation Brands. Okay, the next stock on my list would be Target. And I actually had comments, people asked me about Target. And if you look at Target, Target has a very interesting profile also. They went through some issues here in the last 4 or 5 years with earnings. Their forecast earnings growth is improving quite a bit, expected to run about 5%. Because of the low valuation, I could get over a 21% annualized rate of return going forward. All right, so Target fits the bill. It's yielding right at 5%, so it helps me maintain my dividend yield. Because again, I wanted to build a portfolio that generated a 5% yield. This is for someone either already retired or getting ready to go into retirement. Okay, so that was Target added to the portfolio. I think I've covered all 5 of them now. Keurig, Smucker, Constellation Brands, Target. I'm missing one. I'm missing Verizon. I added Verizon because, again, I told you, that's what I told you about in the beginning. So let's go ahead and look at Verizon. And again, I've originally built the 15 core stocks in the portfolio. Now, Verizon is once again a stock that is undervalued. It offers the 6.67% dividend yield. Because of the high yield, it gave me the opportunity to make money. But because it's got a high yield, and I mentioned this in the last video, these slower growing, high yielding stocks don't tend to give you much. This is only expected to grow at around 3 1/3% a year, but I do believe it's worth 15 times earnings. That would be a 41% rate of return. The market's been putting a discount of about 9.5 times earnings, which would still give me a 17% annualized rate of return, and it would still be undervalued. So I've now topped off this portfolio, and I've got expected dividend growth, and we'll be adding a feature on FastGraph soon where we'll be showing the dividend growth much more clearly. But the bottom line is the portfolio is doing reasonably well so far. It's eked out a little bit of a gain. Now, as of today, it's increased by 30,000. So it went from 1,996,000 to 2,026,900. All right, and the annual rate of return, because we're talking 7 days, it makes this number look ridiculous. You have to wait till we get to a year out or 2 years out before we start seeing any relevance to this annualized rate of return. Our total return has been 1.51%, but we got a current dividend yield of over 5% and the opportunity for that dividend yield to grow. Okay, as far as sector diversification, it's reasonably well diversified. Part of the problem here is you can only take what the market gives you. So we did include quite a few consumer staples because I can get the income, but I don't get the growth. We have some 14% real estate, a little bit of communication services. We have a small position in information technology and a smaller position even yet in utilities and a real small position in materials. All right, and you can see the sectors and the weightings and how much money we have invested in each sector. But the bottom line is we're well diversified. Now, this is the bubble chart, and this shows the weighting now. These all started out at about a 5% position, okay? And you can see that some of them that have performed the best have increased that a little bit. But again, this is all really early in the process, and none of these things are anything that really get my attention at this point. But 6 months from now, a year from now, 2 years from now, 3 years from now is what I want to see this portfolio doing. Now, I'm going to make another comment about this portfolio. Okay, what I'm going to do differently than the model portfolios I've built in the past, which I'll be updating sometime in the spring. The model portfolios were just kind of what I jokingly called the Ronco commercial. Those of you who are familiar with that old commercial where the man always said, just set them and forget them. But that's what we built those parts, just buy value and hold it. This portfolio is going to be managed. Okay, what that means is I can make changes if I get better opportunities to replace stocks, if I start to get fundamental deterioration. I don't react to price too much unless fundamentals are deteriorating as well. But we are going to manage this, which means we can be buying and selling. You'll find it to be very rare. It won't be a lot of buying and selling. But we are going to manage this portfolio to try to keep the integrity of the portfolio intact. What does that mean? That means we're looking for a portfolio that's generating an average of 5% yield that's increasing every year because most of the stocks increase their dividends, some at a high rate, some at a lower rate. But on average, I haven't really run that calculation yet, but I'm guessing we're going to get maybe 6% dividend growth in this portfolio. So I would expect the income to increase by 6% or better going forward. To really run through this and buzz through this quickly now, I want to go through the valuations that we bought these at, because I think that's critically important. So we're going to start with AES Corporation. Now, some people complained about this one in the comment section because they didn't like the debt. This is an independent power company, which means it's a big infrastructure play. And I think they're earning a lot better returns on their capital than they are paying for the debt. Plus, they have the cash flows to cover their debt. And the real key here is how undervalued this stock is. All right, so let me see if I can get this with my green dots, because some reason it didn't show up there. Yeah, there we go. So we bought this stock, in my view, at a very inexpensive valuation. The next stock is Avnet. I like the future growth of this stock. It has a shorter dividend record, but I feel like we bought this at a very attractive value as well. We bought it on a downtick, and the earnings forecasts look very good. Best Buy, you can see it. These are all just brand new holdings. That's basically what I'm trying to get across here. They're brand new holdings that were just purchased. Here's British American Tobacco. And once again, it was just purchased. And it's actually gone up from where we bought it. You can see that better if I shorten the time frame. The price, we bought it at $54.86. The price is now $58.13. Edison International is another stock with debt because it's another utility stock. Okay, here we see we bought it at a very attractive valuation, in my opinion, at $58.42. It's down a little bit, but not very much. It's basically trading at what we bought it at. Interpublic Group, which is an advertiser, and Omnicom they're talking about merging. This would be a company that might not be being replaced, but it's compellingly inexpensive, and it might be taken over by Omnicom here very soon. So I'm kind of intrigued about that. Keurig Dr Pepper, this was a stock that was trading at high multiples, but again, when I shortened the time frame, we bought it below a 15 multiple, and we've got good potential, and we avoided all this overvaluation here by adding the stock now. Altria, or the old Philip Morris, I like to call it, still kept the symbol MO, is why I keep remembering that, was also bought on a downtick, but we think at a very attractive valuation. And again, don't be afraid to run time frames to get different perspectives of how fast or slow a company's growing. Is it increasing in value or decreasing? Is its growth rate increasing or decreasing? Very important message. So there's Altria. The next would be the REIT. Here we're using adjusted funds from operations. And once again, it was purchased. You can see these purchases. The beauty of this is when you use a fast graph tool like this, you can see the fact that you purchased them at a price below the intrinsic value, which is the orange line on the graph. And then you can track how that worked out over time. And that becomes very, very important in terms of valuation matters and matters a lot, which I always say. So Realty Income was bought, I think, very attractive. Note that this is considered maybe the highest quality REIT in the world. It's the monthly income stock. It does pay monthly income, which was something I liked, and it does have a yield over 5%. But look at the valuations the market has historically put on this stock, and we're buying it at a very rare opportunity to buy it at a valuation which is below the actual intrinsic value, which is reflected in the orange line. Now, we also bought Oneok, which is an oil and gas transportation company. This was another higher yield stock, 5.6%. We bought it at a very attractive valuation. When you're looking at dividend coverage on a stock like this, I like to look for dividend coverage that's covered by the operating cash flows and even the free cash flows. But because of the capital intensity of these companies, you're going to not see free cash flow be as consistent as you would in a normal operating company. Okay, the next stock on the list would be OMC, and this is the one I told you about that's basically going to merge with IPG, and at least they're planning on it, and both of these stocks are very cheap. They have a nice dividend yield. This part of the portfolio will almost assuredly change, but I believe there'll be some money to be made in the shorter run. But then I've got to look for something that maintains my dividend yield going forward. Prudential Financial, I think we're buying this at an extremely attractive value. Just at a 5% dividend yield today if you bought it today. I already went through St. Smucker. Sonoco, we talked about quite a bit last week. I like the future growth potential of this company. And so here we have this portfolio that's bought at these incredible valuations, and we've got some really good upside as a result of that built into this portfolio, which would be another reason where we might source some money. If any of these stocks go from being undervalued to overvalued, that would be part of management. We might end up taking some or all the money off the table and putting it into some companies that have maybe come into fair value. And there's a lot of examples about that, by the way. As I've always said, valuation matters, and it matters a lot. And you can see that just by glancing at these graphs, where there were periods where Target grew at a very high rate during this period of time right here. And of course, the stock traded at higher multiples, but also got overvalued. And then when we had a big drop in earnings, we seen a big drop in stock price, and another drop in earnings this year caused another drop. But looking forward on the company, which I think I've already showed you, we're still expecting about 5% growth going forward. T. Rowe Price Group was another financial that I felt we're buying at a really good rate with my 5% dividend yield on the mutton. And this company has paid special dividends. You can see how this gold line is the dividend line. And there were periods of time where they paid a $7.32 dividend when their normal dividend was $3.60. So they paid like a $3 extra dividend. They've done that several times during this time frame, which is another reason that intrigued me with the company. And this is an experiential REIT. I like to cut out that aberrant year here. It's forecast to grow at a very attractive valuation. And we're down a little bit on it, but we bought this one right as well, in my opinion. I think we made a really good purchase here for a long-term hold with a 6% dividend yield, 6.3. And then last but not least, we've already gone through Verizon. This was the one that was just added today. We just bought Verizon, and we feel like we bought it at a very low price, and the value the stock could generate some really strong rates of return going forward based on forecasting here, 30% total rates of return, even at a discounted normal PE of 13. And if you went to 15, the number would be even higher than that. So there you have it. You have this portfolio of 20 stocks now we'll be tracking as time goes on. So remember, this is built for someone who's in retirement now or very near retirement, hypothetically. It would work for that kind of investor as well. But they needed to get at least a 5% dividend yield off of their portfolio. So when we're building a portfolio, we're building it according to the goals, needs, objectives, and risk tolerances of the individual investor we're building the portfolio for. Here we needed income growth, which I think we've achieved, and we'll be tracking that. But we also wanted some capital appreciation potential. But most importantly, we wanted to make sure we had enough income organically coming from the portfolio to meet the investor's needs. And then more importantly, make sure that that income had the opportunity to increase every year so that they could fight inflation from a standard of living point of view. And then ultimately, I think over the long run, 3 to 5 years or longer, this portfolio will also generate some nice capital gain potential. And again, it's going to be managed and we'll be following it. So anyway, if you like this video, give me a like, ring the bell, subscribe to our YouTube channel. And I call fast graphs the value investor's best friend. I can't even imagine owning stocks without having the perspective that fast graphs gives. It's a tool to think with. Some people have a little trouble understanding it, but once you get it, I think you'll understand why it's such a valuable tool to have if you're an investor of any kind. Thanks for watching, and in the next video, I'm going to be switching to a portfolio where we're going to focus on dividend growth and not so much current dividend yield. That's the difference. This would be a portfolio we're going to design for a hypothetical investor that, say, has 20, 30 years or more before they retire, and we want to build a portfolio that's going to give them good growth potential as well as good long-term income potential. So that'll be the next video in this series, a portfolio focusing on dividend growth. And a yield, I'm going to try to shoot for a yield above the S&P 500 because I'm not going to try to beat the S&P 500 in the short run, but I would like to beat it on an income and an income-producing basis. Thanks for watching.